From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, July 17th. We're back on the Macrocast. Tony Fratto from New York City. Brendan Walsh and John Fagan from Markets Policy Partners in the DC metropolitan area. Guys, we don't have a big jobs report this week. We don't have, lots of other, major economic news this week, but we do have the end of the first week of earnings, and hearing from companies how they're dealing with this economy in the second quarter. So we got the first reports on those this week, and especially from the large banks. Brendan, what do we learn from them? What should we glean from those earnings reports?
So it was actually a very interesting report. So in times of crisis, apparently investment banking does quite well, especially trading. So all the big banks that have huge trading desks like Goldman Sachs, Morgan Stanley, they had really their best quarter ever. And when you kind of look back on it, it shouldn't be shocking. COVID, it didn't come out of nowhere. We knew it was coming, but we kind of ignored it until we had to shut down. The market went down 30%. Rates went down. Credit blew out. Then the Fed and Capitol Hill stepped in and kind of saved us. And we had one of the biggest stimuluses we've ever seen, and the market came right back. You had huge volatility, everyone sold, and then you had huge volatility, everyone bought. That's a recipe for monstrous amounts of money for investment banks to make money, and they did. So, but what we saw was the banks that are much more skewed to investment banking really did really, really well. The banks that have both investment banking and regular commercial and retail banking, they lagged behind a little bit because they had to take extra reserves for future losses. So I think that's the setup we're going to see going into next week, where the big investment banks are done reporting, and next week we have the more traditional regional banks. So I think that the focus going forward next week is going to be on credit and how their books are performing. Because the big banks, the Bank of America, Wells Fargo, JP Morgan, their books are national. Regional banks, by definition, are more regional, so they can be more exposed to, like an individual company that really is having a hard time. So I think we'll get an interesting, a picture of what's going on in individual states and regions coming forward next week.
Brendan, sticking with the big banks, I think you're right. Trading blew it out of the water. JP Morgan, huge, huge report from their trading desks. Same with Morgan Stanley, we saw yesterday. But we also saw, fairly significant loan loss provisioning. Also, the provisioning was pretty huge, and I don't know if we've totaled it up for the banks who reported this week with the totals they have in terms.
Yeah, the big guys were all around $5 billion, which was in line. So it should be stated that the big banks were in line, other than Wells Fargo. So Wells Fargo was a disappointment. But they've had their own problems going on for a while, and I think Charlie Scharf is doing a good job of putting the bank back on right footing. But a bank that size, $1 trillion bank, takes a little while to fix your loan book. But all of them also did say we have no idea no one gave any guidance on the future. But I guess
the guidance was they have no guidance.
They said don't expect third quarter trading to be the same as second quarter trading. With a little bit of disappointment to the market.
I was talking to somebody at one of the large banks the other day, and they said the traders all think they're brilliant now.
Yeah, no,
like
it's hysterical when it comes to bonus time.
Yeah,
I made the bank $7 trillion. Well, not really.
Right. Yeah, that was a quarter.
Yeah, you answered the phone.
Right. That was a quarter that we hope we never ever see again.
Exactly.
And we'll likely never ever see again.
Knock on wood.
Yeah.
Yeah, it was certainly surprising. And we mentioned the very low visibility with guidance mostly pulled into the already before the second quarter. And so
that's true of every company, not just banks.
Yeah, in terms of earnings, it's a pretty small sample size so far, only 45 companies of the S&P 500 have reported so far, but we've got 86% of reporting companies posting an upside earnings surprise. And the upside earnings surprise, the quantum of surprise is 17 percentage points. That's a really high, 17% is a really high earnings surprise. So this is setting the tone for, obviously, again, very low visibility into the coming quarters. We knew that, but this quarter, analysts really haven't gotten a good handle on what these numbers are going to be. And we saw that with Netflix last evening when they came out with their projections for additional subscribers over the coming months. And those projections were a country mile from where estimates were. This is just going to be a recurring theme where analysts aren't really even in the ballpark of some of these numbers.
And what's happening on the earnings is the same that's happening on, the macro indicators. So, we see some spending going back up, but then, we have a COVID problem and it pulls back down. It's the same with earnings. Just because, a bunch of people signed up for Netflix in the first quarter when we were on quarantine doesn't mean that the same amount are going to sign up when, you can go outside again. But again, we're shutting down maybe again. So maybe fourth quarter will look better.
Thus far in earnings season, all the variability and the clouded guidance from the banks and the disappointment from Netflix that came out last night, it's not affecting overall sentiment so far. The S&P has been a little bit back and forth, but still to the upside. We've seen some underperformance of tech this week, but that's more of a function of just how outrageous the rally has been up until now, taking a little bit of a breather. Netflix disappointment hasn't really weighed on the rest of tech, at least so far today. So we saw in the first quarter companies getting something of a free pass. Obviously, the discrete announcement effect would impact stocks on that daily basis. But broadly speaking, investors still have their view on the horizon, and as cloudy as it might be. And
so for Netflix, 5 of the last 6 earnings, their stock has been down the day of earnings, and Netflix is at all-time highs.
What is the deal? What was the I didn't look closely at Netflix. I was focusing on some of the broaders. And by the way, I wasn't even looking forward to Netflix because I just assumed that they're crushing it and ought to be crushing it. And so I didn't really care all that much. And then I saw it's a disappointment. What was the disappointment?
Well, they still are crushing it. But basically, so many people signed up for Netflix in the first half of the year that the second half of the year, they pulled forward a huge amount of demand. So they're not expecting the same amount of new subscriptions, and also advertising is going to be not at the same trajectory. But that's actually a good example. So John, so you were talking about the S&P and NASDAQ. They're kind of back. Well, the NASDAQ's at all-time highs, and the S&P is fairly close. Is that story being told across other markets? Is that something we can glean, as a macro data point, or are other markets showing the pain of the COVID crisis?
Yeah, certainly looking across, if you cast an eye toward the Russell 2000, which is the more mid-cap market, that is still down 12% on the year. And certainly within the S&P 500, as we've discussed in the past, the just yawning disparity between the performance of the different sectors. I'm looking at the KBW Bank Index, which is the major U.S. mega banks stock basket. That's down 34% on the year. When the S&P 500 is essentially flat. It's down 0.5% year on year.
Yeah, that's shocking.
And when you look at the NASDAQ composite is up 17% year to date, and just knocking on the door again of all-time highs, which we put in last Friday. This is just a massive divergence of performance, and it speaks to winners and losers of the pandemic, the stocks that are deemed bulletproof, and winners like Netflix and like Facebook, and they just continue to rally, aside from some technical divots in their uptrend is all we've seen.
It really is it's a tale of two economies right now, isn't it? And it seems like those large companies, I love the big companies that they're innovative and globally active, and this is I'm nothing to say negative about them, but they're in they're in positions where they can, unless you're an airline, you can find ways to adapt and support for like the basic underlying support for capital markets helps them out a great deal. PPP helped a lot of small companies. Kept people employed for a good period of time. Companies in the middle, like these are names that you don't know. Like they're like the names like when you drive out to the airport, and you see companies along the side of the road, and they all have names on them, right? They're all doing really good business. They're all really great companies, but like you don't know their names. They're not really usually B2C kinds of businesses, or usually B2B kinds of businesses. So you have no reason to know their names. Those companies are all having really tough times, and the same kind of support hasn't been there for them. No one's pushing money at them. We saw with like even if things like the Main Street Lending Program.
That's a great point, because so the Main Street Lending Program just purchased $12 million of their first loans.
I can't even. I don't think people. I mean, it's mind-boggling, right?
And it's because it goes to the exact point you were making. The Main Street Lending Program is essentially giving you the same, if not maybe slightly worse, terms than your bank would.
Right.
So good companies can either tap capital markets or just go to their bank and get a loan. They don't need to go to the Fed for this. So if the Fed wants the Main Street Lending Program to do it, they don't have to quite go as far as PPP, where you don't have to repay it, but you have to put it at such amazing terms that you're giving these banks a lifeline, not just a loan.
And also, you have to also wonder what, like, so PPP was essentially a cash grant for companies. If you used it the right way, it was a cash grant. May need to do that again for a lot of companies, but for these businesses that are mid-market kinds of businesses, even if they're in the Russell 2000, they're larger and they're publicly traded, right? But the question is, what is the business case for them, right? It was one thing if you're talking about a lifeline to get through a couple months, but if it looks like this is going to go on for longer, you don't want to borrow against that, right? You can't, I know. Right? You're not going to.
And I think that's the reality is, until we get a vaccine, what you see is kind of what you get. Every time that people have reopened and kind of gone willy-nilly, infections spike and you have to shut down. There's rumors that Texas is going to shut down today. So Dr. Fauci said, I think we can have one by the end of the year. So if you're a business, and I think if you're the Fed or if you're Capitol Hill, you have to assume 2020 is done. It's written off. What you see is what you get. We're not reopening. So we have 5-6 months to get these companies through, or they go bankrupt. I don't know, whether that's a big check to write to keep, 20% of the economy still open, but that's the reality. Gyms, I'm not going to gym.
We can tell.
I don't.
I'm not going to the gym either, Brendan. I am going to the kitchen a lot, though.
Yeah.
All right. Well, so we had earnings. Why don't we take a break here, come back, talk about, we got some ECB. I'm going to get global a little bit and just think about what the rest of the world is doing. We focus on U.S. quite a bit. But I want to dive into what ECB is doing and the way they're trying to support that recovering economy. Now, you're listening to the Macrocast.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
All right, we're back on the Macrocast. Guys, we're on the verge of Europe passing what will be a pretty big and historic fiscal package, unusual for them, unprecedented actually for them, and the support's going to be there. But I think what's interesting in a way, it's they're kind of late. It's been a long time coming. Would have loved to have seen this a couple months ago. At the same time, something they're not late on was, bending the curve on COVID, and the number of cases and deaths, and like whatever they did it right. And you look at compared to the United States, these economies diverged with respect to COVID about a month and a half ago, where U.S. cases were continue to climb. Now we have cases, hospitalizations, and deaths all climbing. Europe bent it down, flattened it almost to nothing now, where you have a lot of countries who have reporting almost no cases, no deaths, and it's showing up in their economic results. They have been because they were disciplined. They have been able to reopen. Brendan, I think you told me some data point about in Germany, about German restaurants.
Yeah, so Open Table, where the online restaurant booking. So in Germany, reservations are actually up 5.5% year over year, where in the United States, we're down 64%. So, people complained about the lockdown, but if you did a proper 3-month lockdown, you actually got the virus out of the country enough, you can properly reopen with proper restrictions. But come Memorial Day, we wanted to have a fun summer, and we reopened, and we're paying the price now.
Europe's definitely had a very good couple of months. The starting gun from where we sat was the Franco-German proposal in mid-May, where they came and presented this. At the time, it was a $500 billion euro fiscal package that contained this element of fiscal federalism that the Europeans had shied away from for years, and had always been such an Achilles heel of the union. And
it took the markets a while to realize the significance of this.
Yeah, and to put that on the table and to basically raise money in the regular proportionate European way, but to spend it where it's needed, presumably the Southern European countries that had been having a much more adverse experience with COVID, that was novel. And certainly structuring it to emphasize grants instead of loans, that was also a huge part of really the step forward that this package represented. And then ahead of the June ahead of the European Commission leaders meeting later that month, the final bill was even upsized from that to $750 billion.
Yeah.
And then having even more favorable and sort of fiscally cementing kind of terms. They're still negotiating it. This is Europe. But the fact that Chancellor Merkel and President Macron and ECB President Lagarde are all pulling for this thing, we all know that what they call the frugal four, it's Austria, it's so it's Austria, it's the Netherlands, it's Denmark and Sweden are trying to steer this thing back toward loans instead of grants, and to not tie themselves together in such a tight fiscal union, what they call the debt transfer union or so forth. But that is they're negotiating it today and tomorrow at the July EU Leaders Summit. During this period of time, the ECB at their June meeting came back. The European Central Bank got even more aggressive than expected in terms of beefing up their asset purchase programs. We just had a meeting earlier this week, and President Lagarde was again very forceful in her commitment to following through on these asset purchase programs. There was a sense, and there was some noise from from some other European officials, that maybe they're doing so well on the COVID containment side that they don't need to follow through. Well, Christine Lagarde put that to bed and redoubled their commitment on that front. Expectations are that they may even do more down the road. And that's combined, and it's shown up in European assets over the last couple of months. So since that mid-May period, the euro is up about 5.7% versus the dollar. That's a pretty big move.
Huge. Yeah.
Up toward about 12-month highs. The Euro Stocks Index, which is still on a year-to-date basis underperforming the S&P 500, is up over 20%, about 22% over that period of time, versus a not too shabby 9% for the S&P 500. The S&P 500 got a pretty big head start, so it's flat for the year, whereas the European index is still down. Let's see, about 10% on the year. But that's a really meaningful move over the past couple of months, with things really giving Europe a tailwind here that they hopefully will capitalize on and come to an agreement on this historical fiscal package.
We should, I mean, we shouldn't be sanguine about what what the economy looks like in Europe, right? Because the hole is big. And it looks like they're pointed in the right direction, and we should feel good about their outlook and their direction, and getting out of it. And they seem to be doing all the right things. The hole's big, though, right? I mean, I think Lagarde estimated the GDP loss this year of something in the 8 to 12% range, which is pretty bigger than the global financial crisis, pretty massive. Yeah.
I remember when she was elected, you made the point that she could be the right person for the job because of her background. She's good at bringing people together. That statement turned out to be way truer than we could have ever imagined.
We were pretty prescient, weren't we?
Yes, unfortunately.
Yeah, we didn't think she was going to need it that quickly, but she probably is the right person for the job at the right time.
Yeah.
Very quickly we saw Chinese numbers too. They reported positive growth of about 3.2% or so. Do we believe those numbers? It's a question always with the Chinese, but And
do we believe the stock market rally? John, you have more experience with China than the rest of us.
Yeah, grain of salt is always how you want to take Chinese economic numbers, but certainly they've, over the last, during the COVID period, they've been, publishing figures that would previously have been unthinkable. Negative, what was it? Negative 6.8 in the first quarter.
Yeah.
That's pretty low number. 3.2 isn't exactly shooting the lights out. They came up with, we also got some June economic data, retail sales, industrial production, and fixed asset investment. Retail sales still came in a little bit light. And, the commentary from corporates, I think, is going to be pretty interesting. We're hearing that, on the manufacturing side, there's a sense that China is coming back, but that's being hampered by depressed demand in the rest of the world, in the U.S. and Europe, so their export markets. And so that's maybe holding things back to some extent. But it is interesting to see that retail sales were the laggard in China when they're supposed to be, closest in the world to resuming normal course of business and economic behavior. So, there was at the very beginning of this month, the state media in China started putting out indications that it was a good time to start buying stocks. Front page, on the one of their securities newspapers. Front page.
I should laugh. We have a president who regularly does the same thing.
Yeah,
so.
Yeah. So it's the known flavor. But this is an unknown in Beijing as well. They cut some of the restrictions on margin debt for speculative activity, and boom, it was it went straight up. The Shanghai Composite rocketed northward, but within almost as swiftly as it started, the leadership in Beijing appears to have gotten cold feet on this, and is now talking down the market. This is not.
Well, they've also, we've had some, a little bit of choppiness with on the COVID response too, right? So they've had to do some additional lockdowns again in China. Some worrisome reports out of Korea and Japan also over the past.
When Beijing goes back to the well, they've obviously not taken the foot on the gas kind of approach to stimulus that they did in 2009 and 2015-16, when they were basically throwing the kitchen sink in terms of credit at their economy to get it back up to where it had been. and recover from these big divots that we've seen. This is a much more measured approach to Chinese stimulus. They are not gunning the engines here. That's been consistent messaging. The fact that they kind of went back to the well with this, boost up the stock market as kind of a tactic to get animal spirits going, kind of shows that maybe they're trying to twist some other dials, but it's a little puzzling, and the outlook for their growth has been good, not great, it seems.
One thing I do want to talk about, we've let it go for a little bit, but maybe we come back in the next segment, and we haven't really dived into the U.S. China U.S. China competition. Is competition?
That's a nice way to say it.
It's not adequate. It's a complex. If it is a competition or antagonism, maybe we'll come back let's come back in the next segment and take a little bit closer look at what's going on with U.S. and China right now, what it means for the rest of the year. You're listening to the Macrocast, and we'll be right back.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, we're back on the Macrocast. Guys, I don't know, I was struggling for the word, what we call this. Cold War has already been used for
right.
History, and I don't want to call it Cold War II, but but for those of us who, if you're my age, you sort of remember this kind of, bilateral competition for ideas and, economic and strategic advantage. And we're really seeing that with the U.S. and China right now. Some of the flashpoints that we see, aside from the trade relationship, which does have a macro impact, a lot of these things don't have a macroeconomic impact. If the U.S., which is, today is very successful in getting the U.K. to, not to, allow Huawei for its 5G systems. It doesn't have a macro impact, but definitely has a strategic impact on the relationship. And look, it may have been China doing it to itself because of its treatment of Hong Kong. That may have been more persuasive than Trump administration lobbying. But regardless, these are the kinds of things, these sort of little proxy wars, strategic advantage, looking at what's going on in South China Sea, treatment of North Korea. The NBA will be caught up in this again because China is such a huge market for them once NBA is allowed to play basketball again. And they're I think we're going to be looking at this for a long time for both economies, both countries searching for hegemony in the way to do business and searching for example and for advantage. And I don't think that changes even if we end up with a Biden administration.
That's the most important point. Yeah, but the Huawei issue, that's a national security issue. And basically the U.S. told them, if you want to talk to us, our CIA, you can't be on Huawei because we can't trust that the Chinese aren't tapping us. And that would be true whether it's Biden, whether it's Mayor Buttigieg.
Yeah, and that's obviously a Biden administration would come at this issue with a different style and a different set of priorities. Joe Biden has spoken about this in some of his speeches recently, and said, characteristically, the emphasis would be on a more multilateral approach. The Trump administration doesn't necessarily work that way, but they certainly do pressure allies. And we saw this week the fact that the UK banned Huawei from its 5G telecom network. That was a big win for the Trump administration. Mm-hmm. This is, something that is part and parcel of what we're characterizing. We discussed the sort of tired Cold War analogy. It's easy to default to that kind of framework because what this is doesn't necessarily roll off the tongue. We reference it as basically a multi-front long-term policy campaign to counter China. So, counter China is the approach. And the fronts most obviously right now are on trade, certainly, tech, 5G and Huawei, investment. We've seen the issues about delisting Chinese companies in the U.S. and the threats there over their lack of disclosure. Human rights / Hong Kong. This is beginning to be more prominent within the Trump administration. It would certainly be more prominent if there's a Biden administration. Supply chain is kind of flying under the radar, but that's part of this national security discussion, which is going on about how to protect our critical national functions, which are not just, medical supply chains. They are really across the board, and how to, first of all, understand them, and then whether we can actually bring them onshore or replicate them here onshore for, potential future issues. And this is all kind of going to the other front, which is the geostrategic front.
Yeah.
It doesn't show up, geostrategic issues don't really show up in financial markets. It's really hard to price in, but we saw some heated rhetoric around the South China Sea and the U.S. specifically rejecting China's territorial claims there, which is something that the U.S. had refrained from doing before. The U.S. had merely pushed for freedom of navigation, but now this is a much more explicit posture. The Chinese obviously pushed back. It's a real issue.
It's hard to see us not spinning into a more confrontational posture, right? Where it seemed like if we were talking about this, and we were talking about this last year, the confrontation was to gain advantage in trade negotiations, and it was largely confined to differences on understanding of the trading relationship between the U.S. and China. I think to me the spark of Hong Kong and how it bled into the NBA became aware. The Americans became more aware of Hong Kong because of the NBA. We tend to ignore the culture, the culture piece of it. I see us moving into the concerns on the cultural relationship between the two countries and things like TikTok, right? On these questions of human rights and treatment of people, Uyghurs. Where I could see those issues elevating in importance, and where those, which was a trade dispute, we are now seeing in strategic and cultural, confrontation that will then go back and feed the, more confrontation on trade and other areas. And so if you're market participants thinking about that relationship, if you're looking at companies that have extensive supply chains, in China, if you have companies that rely on the Chinese market as either an export market, or if you're like a General Motors where you build lots of products in China for the Chinese market, it becomes a very, an increasingly complex environment and much more difficult to anticipate the direction that it's going to go. And so I think that's a risk going forward. And again, we said this, regardless of the Biden administration, the truth is I could actually see Biden administration being, less, the rhetoric might change. The means might change, right? It's from a bilateral, seeking bilateral solutions to multilateral solutions, but not at all a weakening, and maybe even a toughening.
It could be a strengthening,
a toughening of the relationship in a Biden administration, if only because we've seen from President Trump and from his Rose Garden talk the other day, clearly his point is going to be that Biden is weak on China. So you could see Biden trying to overshoot on being tough on China.
Yeah, if you can bring the Five Eyes together and have a unified response to China rather than kind of attacking each Five Eye individually to bully them into what you want to attack China, that could end up in a much more strict, I guess is the word, response to Chinese policy.
Yep.
Yeah, and yesterday, very interestingly, we've seen this theme before from the Trump administration, but Attorney General Barr's remarks yesterday on China, which were very hawkish, notably pointed to U.S. companies, specifically Disney and Apple among them, as basically caving in to Chinese demands from the Chinese Communist Party from Beijing to censor and behave in ways that they wouldn't otherwise. And he urged U.S. corporate leaders to understand the stakes. And this is neither side has really gotten to the point where they're ready to say, all right, to global corporations, all right, pick a side, but that is,
by the way,
clear.
Yeah, and look for all companies everywhere have to respect local rules. It's not to I'm not apologizing for it. I wish it could be more. I wish everyone could be a little bit stronger on on concerns with China, but not just China. I mean, we'd see this in in lots of local markets, whether it's Saudi Arabia, or countries in Africa and Europe, and and China. So China is certainly going to be a particular flashpoint, and I would be the thing we'll be looking for are some of the policy commitments that that either Trump or Biden make over the next 4 or 5 months, because they're going to execute them. The commitments they make in the campaigns, I guarantee you they will try to execute them in 2021.
Yeah, my favorite one that came out this week was that we're going to put restrictions on the members of the Chinese Communist Party, which is 90 million people. That'd be a third of America.
Well, hey, we have earnings continue next week. What are we looking at? Which we expect next week?
So a lot of it is the regional banks. So that'll give us some interesting macro data points in terms of how each individual region is going. But then we get just normal companies again. So things like IBM and Coca-Cola. Tesla is always fun. We get some of the airlines, Southwest, American. We saw this week that American and JetBlue are going to kind of team together. Royal Caribbean and Verizon. So it's a pretty broad base of American companies. And then we get the market PMIs globally. So we'll get a sense of how the manufacturing, but also the service sector. They do both manufacturing and service.
So we'll fill out the picture a little bit more next week with what we hear there.
Yep.
All right, guys. Good show. Have a great weekend. Stay safe. We'll be back next week with the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.